Checking out the Market Chameleon Market Show. Before we get started, please take a look at the shared disclaimer and be aware that neither Market Chameleon, Dimitri, or myself are registered investment advisors or broker dealer. If you are searching for investment advice, please reach out to a licensed professional. This show is for informational purposes only concerning Market Chameleon tools and products. With that, D, you ready to roll?
Yep. Good morning, everyone. And let me share my screen here. As I'm doing that, if a quick note to anyone joining us for the first time, Will and I, we do these shows in the morning to try to help answer questions you may have about the Market Chameleon tools, the data, or the analytics. If you have a question, type it into that live chat on YouTube. Will's keeping an eye on it, and he'll let me know, read it back to me. To give you a couple minutes to put those questions in, we're going to take a look at our pre-market report, see if we could get insights, what's going on in a pre-market hours, and then we will move on to our questions. So we'll start out here, pre-market report. And as you could see up top, we have this calendar view, which allows you to go back in time to see what happened in the pre-market hours on those historical dates. We also show some summary statistics, and this allows you to eyeball the most recent history and compare it to today's pre-market activity to spot if there's anything unusual or a trend. Let's take a look at today's activity, which is July 24th over here. We could see that so far we have 343 stocks trading higher in the pre-market, 544 stocks trading lower. We have 209 million shares trading on up volume, 137 million on down volume, and we have $986 million worth of stock trading higher, $4.8 billion worth of stock trading lower. From that perspective, it looks like so far pre-market trading activity indicates a bearish sentiment, bearish lean. Let's look at it from a couple more angles, and then we'll move on to our questions. So I'm going to slide down the page a little bit. And now we get this more granular view of what's going on in pre-market hours. We see stock symbols with price and price changes and the volume. We also have our most active stocks, our biggest percentage gainers, our biggest percentage decliners. And on this list, we see we have 63 stocks that made it onto our biggest percentage gainers list, 144 stocks that made it onto our biggest decliners list. And from that perspective, it looks like there's also bearish bias in pre-market trading activity. Now, to make it onto this list, we do set thresholds in place because stocks in the pre-market could have very low liquidity, volume. If it meets our thresholds, it could make it onto this list, and that will include low cap stocks. It could be an ETF, a closed-end fund, a leveraged ETF, even an inverse ETF that moves in opposite directions of the underlying. So to narrow down this list further, we could use our filters above. Over here, if you have a watch list and you save the group of stocks, you could filter by your watch list. We're going to use this filter here in ETF in our example. And when I click on it, you get this drop-down menu to select from. These are different ETFs. We're going to go ahead and choose SPY, the first ETF. So when we click on that, what this will do is filter out this report by the stocks that are holdings in the SPY ETF. And what we essentially did was narrow down the group of stocks we're analyzing to the S&P 500 companies, because that's what the SPY ETF is. And here we see 5 stocks made it onto our biggest percentage gainers list. We got 28 that got onto our biggest percentage decliners list. And that also indicates that so far trading in the pre-market hours has a a bearish or negative more sentiment in the pre-market trading. We looked at it from a couple different perspectives. They all kind of point to the same thing. We are a couple minutes into it, Will. So at this point, I'll take questions.
Yeah, we did have a new Fred Vandenberg came on for the first time today. He's obviously we're in earnings season. We talked about Tesla yesterday. He's looking at SMCI earnings. I did ask for more clarification, but his question was, can you look at SMCI option levels going into earnings? Thanks.
Sure. Okay. So let's take a look at SMCI. Is that the?
Yes.
Okay.
I think that's a big chip manufacturer, but I could be wrong.
Yep. Super microcomputer. Yep.
Yeah.
So is earnings tomorrow? Is that what it? I didn't pick up on that, but okay. Take a look here. Let me just.
I'm showing the last earnings was April 24th.
Okay. Or April 30th was the last one.
Yeah, April 30th.
So, okay, June, July. Okay, so it might be coming up. I didn't pick up a date on this right now because we're still estimating. So I'll check that out. But let me just take a look at the options, how they're set up.
Yeah, we're projecting somewhere between August 5th and August 24th is what we're projecting.
Yeah, so I'm not sure if we know the date yet. For sure. Let me just, I'm not picking out like right now, right now I have a projection, but just to see how this is lined up, how these option implied volatilities are lined up. It suggests that maybe the date is going to fall around here, August, around August 9th. So I think we're still far, like, let me take a look at the news just to make sure.
I'm looking at the news now. I don't see anything popping up about it on our news. I'm gonna.
Okay, yeah. So I'm not sure if that's the case that earnings are tomorrow. So it would be too early to look at that straddle because the straddle wouldn't be representing an earnings event at this point. But we're not picking it up right now that it is tomorrow, unless he has a source that we could cite. But
he actually he's saying August 8th is what he thinks.
Okay, August 8th, right? So that would fall.
Chuck is saying August 6th.
Right.
I don't know where you guys are getting it. If you can share it with me, that'd be great. Where you're seeing the dates, because I still haven't been able to find a release date.
All right. So because we're July 24th and let's say the earnings are August 8th, it's a little bit early to analyze the earnings straddle, right before where is it right before earnings? Because we still have some time to go. We don't know even where the stock is going to be, closer to August 8th. So we don't know if the straddle is going to be at the 780 or wherever. So I think it's too early to analyze it from the perspective of the earnings straddle before, it's just too early. There's still a lot of time between now and then, so I wouldn't be able to really analyze it from that perspective.
All right, there you go.
Yeah, so even if we here, I'll go to August, August 9th, you could see here just this expiration alone, we still have 13 trading days, 17 calendar days to go for that expiration. If you want, I could just look at the historicals, though.
Yeah, let's look at it.
Okay, let's take a look.
We did look the other, maybe it was a couple of weeks ago, Rob asked about Tesla. Another interesting thing is how the stock may have performed going into earnings previously and coming out of earnings is another interesting thing. I think we did that with Tesla a couple of weeks ago. That was cool.
Let's take a look at SMCI since the question came up. Let me just stick with that one. So one of the So when we talked about this actually in Tesla as well, yesterday, and when when you're trading, you have different strategies, exposures. We start to look at benchmarks to compare where the market prices are versus his historical benchmarks. Um, and the reason for it is we want to see, well, where the market price is today versus, the the historical mean, the historical range. Is it on the high end, the low end? Um, and and one of the things that we could do is say, look at where does the option straddle usually uh, end up being priced right before earnings. So we did discuss this idea yesterday that um, right up leading to the earnings, the option straddle itself is going to price in the implied earnings move. Right. So let's not worry about the actual earnings right now, but we know that the option prices themselves will have a binary event priced into them, because that's what earnings are, a volatility event. If we know what day is the earnings, and if everybody knows that earnings are, let's say, August 8th, the market knows that, well, they're going to price in a potential volatility move or an earnings move. And what knowing that, knowing that the earnings are coming out, let's say August 8th, and that the options will be, reflective of that. Well, where do we think usually the option prices will settle at right before the earnings? So keep in mind, we're not actually looking at what the earnings will be. We just want to know where the price of the straddle may end up. Like, what are the potential ranges? Because that could be a trading opportunity. It could be one of a more lucrative trading opportunity than plain earnings. Because if the prices are too low, let's say the volume didn't pick up yet, maybe we know that volume starts picking up closer to the end of the day, pushing up the prices. Well, it could be an opportunity to potentially get in on a straddle at a relatively cheap price and get out of the straddle at a price that's more closer to the mean right before earnings, and forget about the earnings. You move on, right? Because you don't want, because that is a different risk exposure. So then the idea is, well, where do we think that the straddle may be priced right at the end of the day? Right. And that's where we want to see, well, what are the premiums usually? Where are they? And we could look at the average. We could look at the median. We could look at the low end. We could look at the high end. And then from a historical perspective, and then we could compare that to where the markets are today or right now. All right. So this is what this is. This is showing us the historical mean, okay, of the implied move. So if we took the straddle, right, the earnings straddle, and let's say, tomorrow morning, SMCI is going to report earnings. Well, we want to know where do we think the straddle will be today at the end of the close, or even if it reports after the market closed today, we want to know, well, right up to the last minute, where do the straddle usually price? And we convert that price to we'll call the implied move, where this is really the premium in the call and the put that the stock has to move to reach a break-even price, right? For the straddle to break even, exactly. Like if it goes up, for example, let's say it's 11.8%. So if it goes up 11.8% or goes down 11.8%, then that's where the straddle was priced. That's the break-even of the buyer and the seller. So if it moves beyond that, then the buyer of the straddle will be profitable. If it doesn't move at all, like say, then the seller will be profitable, because then it'll just revert back to its normal implied volatility. So here it's saying that on average, the straddle goes out 11.8%. Okay. Let's say 12% to make it easier. So what does that mean? If the stock's $100 and you paid $6 for the call, $6 for the put, well, that's $12. So if the stock's at 100, it has to move $12, which is 12%. That means it has to move up $12 because let's say the put at expiration is worthless, then the call has to make up for the purchase price of the call and the put. So that's a $12 move up or $12 move down, because the put has to be worth at least 12 if the call is worthless. So it's 12, let's say 12%, right? That's what it translates to. But of course, the stock prices are different. They're not 100. So that's why we use percentage. What is the percentage? But 11.8%, that's the average. That's the mean. However, the data, right, doesn't necessarily mean that every time there's earnings, it's exactly 11.8%. That's not how data, the mean works. It could be 11.8% exactly every time, or it could be ranging between 2% and 20% and 5% and 15%. So what is the variance? What is the high, the low? How much does it move around 11.8%? Right? Like, how reliable is this 11.8%? Because it could be all over the place. So that's when we have to go look deeper into the data. So let's click on this. And now here we see the historical straddle premiums here. Right? So here's the average. Here are statistics. On average, if we took the average of all these, it's 11.8%. So this is the dotted line. The dotted line is 11.8%. So, and these bars represent the straddle, the implied straddle move, the straddle premiums for each of those historical earnings dates right before their earnings. So this one's April 24th. You can see January 24th, November 23rd. So these are the dates right before the earnings announcements. Where did it close at? So here we could see already visually that we're not, all these bars, if it was 11.8% each time, all these bars would go up, be at exactly the same height, right? But that's not what's happening here. We see some above, some below, some like this one is well below 7.4%. Here's one 6.6%. But here's some high ones here, 16.4%. So here's our range, our historical range, 16.4, 6.6. So keep in mind, right now, we could look at it, but there's going to be a lot of other premium priced in there, because we have almost 2 weeks of trading that the stock could move, even before we get to the earnings. But as we get closer, then these analytics become more relevant, right? Now, what we see here is that the range is pretty wide. We're talking about 16.4%, 6.6%. I mean, you got 10%. It's a wide range, right? So even if it's 10%, it's below the average, but it's still, you could see here, it's gotten as low as 6.6%. We had at least 2 observations close to that. The median is 12.5%. The median is if we sorted all our data, all our observations from, let's say, high to low. right? If we sorted it, and let's say there are 100 observations, right? Or in this case, it's maybe 20, I don't know, but let's say 100. Well, the median is telling us that 50% of the observations are above 12.5%, 50% are below 12.5. So this just kind of breaks it down into the count. How many, half the observations are above this amount, half the observations are below this amount. And that will be different than the average because the average could get skewed. An average, the way you calculate it is you add up all the observations and then divide it by the number. So if you have one really big outlier, that will pull up the average. So the median is giving us the split up the data, half this way, half that way. Okay. So now what we're doing is we're getting a kind of historical picture of potential outcomes or potential places where this straddle may fall. And it's from a historical perspective. So we're just modeling out. We don't know, it could set up it could be a new high, it could be a new low. We don't know until it happens, but we're getting a perspective of from history, how it tended to close, right? So this is helping us along because now we have more information, more benchmarks to base our decisions. We could also look at by quarter. So here, I don't know what's the next one. Let's say it's second quarter. Well, now we could take our data set and narrow down further to see how the data looked for second quarter. We don't know, every quarter may not look the same in each stock. It could vary. Maybe some of the quarters, the volatility and the implied straddles tend to be lower, some higher. So who knows? Each company is different. Sometimes certain quarters, they might let's say they announce once a year during earnings if they're going to increase or decrease the dividend, right? So maybe that quarter could be more volatile because there's more news, or there's a quarter where they could announce, management could announce new initiatives, products, whatever it is. So that could create more volatility in certain quarters. In certain quarters, it could be just more mellows. So let's narrow down this data further. And let's take a look at just Q2. So click on that. So now we have we only have 4 observations here. Q2 only happens once a year. So this is, last 4 years. And we could see here that for Q2, and this isn't a large data set, but there's a noticeable difference. Oh, sorry, I was thinking of 8%. So there is a difference. I'm not sure if it's significant enough, but there's a difference where the average is 12.6% versus here. We started 11.8% on average with a median of 12.5% for all quarters. So if we just narrowed it down to Q2 as a comparison, we can see the median is kind of right there. It's nothing noticeable difference. The average was pulled up a little bit. And you can see the range here, narrowed down because we have less data, but it's between 14.6 and 10.9. Also, you have to always take into account we only have 4 data points, right? So that's also something always to take into account in your analysis. But this is all that's available. So let's go back. And then the next question will be, well, okay, if I'm going into this straddle, did the straddle, we could look at how the straddle was actually priced relative to the actual move, right? Did that actual move tend to exceed what the straddle was priced at, did it tend to the straddle tend to be just overpriced, and the stock, moved at a much lower volatility? So we could slide down here, and this is what it will tell us. How often did the straddle overestimate the move, meaning it was priced higher than the actual move, or how often did it underestimate the move, meaning that the straddle was priced at the end of the day at a premium that was underestimated or was too low because the move actually exceeded that straddle price. So that would have been 47%. So you can see around 47% and almost 53%. So 47%, the straddle was underpriced. It underestimated the move. 8 out of all these observations. You can see here as you hover over, 9 of those observations, 52%, the straddle was priced above the actual move. And if you're just curious, let's say it's 11 o'clock and we just noticed that the straddle is priced at, I'm going to make it up, right? 9.3%. Let's say it's 9.3%. And you wanted to put in a calculator and say, okay, well, how often did it was the end value at the end of the day below 9.3%, and the rest of it would have been above. So we could put in 9.3%, just going to make up a number, 9.3%. I'm going to calculate that, and you could see that 18% of these observations, see that's where the blue is, 18% of the observations would have been below 9.3%, meaning 72% are above. So from a historical perspective, 9.3% would look like it's near the low range, right? Because 72% of the time by the end of the day was higher. So that's how this calculator would help out with that analytic. So, well, we're right up near the end, so I'm going to stop here because that's kind of a review of this page already.
Yeah, that was awesome, D. Thanks so much. Everyone was really appreciative of that. Thanks for the questions, Fred, and everyone else for communicating on the chat. Great job. All right, D, you have a great day, buddy.
Thanks, everyone. Stay safe out there. Have a great trading day, and hope to see you guys tomorrow.